morning, everybody. My name is Yaxley. I'm the Managing Director of BondAdviser. We've recently become a partner with Prime to provide research and advisory services to the team and help them out with the defensive side of their investments. We've been around, as Simon was saying, for around 8 years now. We are very much specialists in what they call interest rates and credit markets. We look at a wide variety of opportunities in those space. And today we're just going to talk you through a number of things that we're looking at the moment. We're going to start today talking about where we go, what the cash markets are looking like. And we'll talk about a little bit more dive into where interest rates go, where the credit markets then fall in, and then what the alternative space looks like in credit markets as well. I think it's important to understand from our perspective, what we look at is a very, very technical market. It's very different to the way you would look at an equity market. Our job is to simplify this for you. So while some of the terms might be quite technical, if you do have questions, please ask your Prime representative. We're happy to answer any questions. But the key for us is to try and think about how do we sum everything up that is quite technical in a very defensive portfolio and bring it in a simplified form to you. We're in we've been through a very unusual period of interest rates over the last 10 years. The central banks have been interfering with a lot of the mechanisms within the interest rate markets globally. And one of the key things that's obviously affected has been domestically in the term deposit market. So we'll just talk about this briefly. We all know that interest rates are very, very low in Australia. It's been very, very low globally for a significant amount of time. And we are just starting to see a normalisation in interest rates across the board. Now, the important thing, what everybody wants to really know in interest rates, and especially the term deposits, is what does that actually mean? So we'll come on to it in a moment. The futures rates are actually pointing north. But what is important to think about is where long-term average term deposit rates look. And at the moment, they're just starting to tick up. Now, there's a reason behind that, because the way that term deposits work, they are a funding mechanism for the bank. That's the most important thing. The question is really, what is the key funding mechanism for a bank going forward? Is it going to be term deposit markets, or is it going to be more traditional sources of funding and long-term sources of funding like the bond market? Now, historically, if you look 20 years back, you normally would have had interest rates on deposits which were below long-term averages of where the actual RBA rate is set. But that in the last 10 years has not been the case. And one of the most important things to look at now is the banks are awash with liquidity. They actually don't need all these term deposits anymore. So you'll always find that when you go to a bank looking for a TD rate, they're not going to offer up a really good rate at the moment because they have so much liquidity. We don't expect that to change going forward. We actually expect that the interest rates will actually increase at a faster rate than term deposit rates going forward. And hence why we sort of put on there that our expectation going forward is, although the term deposit rates will go up with the prevailing RBA rate, they won't go up quite as fast. This slide here is actually designed to tell you basically what's happening in the derivatives market. So the slide on the left-hand side is actually showing you expectations on the ASX futures market for interest rates. So you can actually see there that a few weeks ago, there was an implied expectation that the RBA cash rate would hit above 1% in the next 12 months. That's not to say in the next 3 months or the next 6 months, but further on in the track. Now, that has actually come off in the last few weeks. There's a number of factors driving that. That can be a result of what's happening in Ukraine. That can be a result of what's happening with in northern New South Wales and in Queensland with the floods. But the key factor here is, for your expectation, is the RBA, the whole market is expecting interest rates to rise. That is how it's working at the moment. Now, at the moment, you can see that it's sitting that line on the lower line on the far right of the left-hand side chart. The futures markets are pricing it to be at around 0.75% within 12 months. That's the key factor, and that's what we're looking at closely. So you can think about that from an income perspective, which is really important when you're talking about things like bank hybrids, because you historically in the last 3 to 6 months, you've had very, very little income coming from what they call BBSW which is shown on the right-hand side of the chart, that income is expected to rise. That's an important factor. It's an important factor for income within all portfolios. So let's think about the next space here, volatility. Now, you bear with us on this. Duration is a complex term. Duration is a very important term in terms for fixed income markets. But the most important thing with fixed income markets is that not all duration is the same. This is one of the things we want to make really, really clear. In a period of volatility when equity markets sell off, well, they have a thing called flight to safety. Now, that does not necessarily mean the whole world goes for the same thing. What tends to happen, and what is shown on the right-hand side, is the flight to safety on a global perspective. It tends to be in US dollars. That's the reason they put it in US dollars, because most things are denominated in US dollars, and it makes a significant influence. It also has an impact, it also can speak volumes for what is actually happening domestically. There's a lot more comfort around what is happening domestically than there is globally, and that's a really important function. Next one. This chart here is also quite a technical chart, but this is the way we look at interest rate cycles. In the global interest rate markets, there's a thing called the MOVE index, which is the same concept as what you will call a VIX index in the equity market. They are measures of volatility, but the point behind them is it looks at long-term cycles and what a cycle will look like for interest rates relative to equities. Now, the reason we're showing you this is because from a strategic perspective, when we're looking at what managers we would allocate to or what instruments we will allocate to, it's very important to think on a forward basis where the right opportunity set is. And as you can see on both charts, what we can actually see is a long-term moving average, but the actual spot point or the last point is significantly different. So what it actually is telling you is that if you can see in the chart between 2021 and 2022 on the left-hand side, you've had what is known as a very tight cycle, so not a lot of movement. So the reason there's not a lot of movement, not a lot of volatility, is because the central bank and the Fed more specifically has been influencing interest rate markets. So there is no volatility. So there is so much liquidity. There is so much, it is so tight. There's so little room to move that worm, that little line has not changed much. However, if you normalize the market and you take that sort of function away, whereas the central banks are not influencing markets, which is effectively what is happening at the moment, you have a significantly large push to the right-hand side of the charts. Now, that's an important function here. What that suggests is there's volatility in interest rate markets, and volatility in interest rate markets generally means interest rates are rising. So that's another thing for us, which is what is very important for us to understand. This is a key point which we will make within all our advisory comments to the investment committee, is to talk about where are we going long-term and what are the key drivers. One of the other key drivers for us is steepness of curves. Now, again, very, very technical. That basically means what's the difference between a long-term interest rate and a short-term interest rate. That really drives a lot of function. That will actually dictate what the market is trying to tell you from economic growth perspective, from an inflation perspective. These are really important functions, and they will drive the key variables for what we make as advice to the team going forward. Next one. Sorry. So one of the other ones that we're just getting onto the next slide. This is, again, an important function. We've got on the left-hand side is effectively the cost of bank funding domestically versus on the right-hand side is the cost of funding across all corporates globally. One of the important functions here is the fact that in the last 10 years, credit markets globally, or public credit markets globally, have become far less liquid than they have before. And there's a number of reasons for that, and we won't go into them today. But one of the key elements that does come out of it is actually the fact that there's a lot more derivatives floating around in the market, and derivatives are actually driving cash returns as well. So these are actually derivative markets. They're actually showing what it does from an index basis. The key point here is, as you can see on the right-hand side of both charts, we're starting to see an increase in costs. That's the key element here. The cost of these things, both globally and domestically, is starting to increase. And why does that matter to your portfolio? That's the key thing. The way that you'll understand, for example, bank hybrids in your portfolio, the way we look at it is in terms of regulatory capital. Globally, they call regulatory capital or bank hybrids, they call them contingent convertibles. On the left-hand side, that is a long-term spread chart of these instruments. As you can see, there's been a significant increase in spreads on hybrids and on a global basis in the last few months. On the right-hand side, we're actually showing is how all parts of the bank capital structure look and at what point, and where the value is for each of these individual points. It's important to remember with credit, everything is relative and it depends on what time series you're looking at. But the important thing for us is we know it's been an expensive market. We also know at the moment that one of the key functions will be for hybrids going forward is that a lot of the banks that will issue these hybrids, they're going to have to offer a little bit of a yield premium in order to sell these into you and into the market. That's an important signal. It actually tells you going forward that your income, which will not only be increasing as a result of your BBSW going up, it will also increase your income across the yield premium that is offered on these things going forward. So we have an expectation that this will, the whole market will move into a more of a fair position over the next few months. But most importantly, that income component of the hybrids going forward is going to increase across both the base rate level and the yield premium level. So we're just turning to emerging markets credit for a moment. It's a really important part of the market. It is also very, very technical. It is also very focused on political influence, obviously. One of the key things that we're showing here is really just to give you a sense of what is happening. The Chinese high yield credit market, the chart on the right-hand side is to show you what's happened over the last year. So that flat line, the greener flat line on the right-hand side, that actually presents the domestic index, being the AusBond Composite Index. It's relatively stable. It's doing what it's supposed to do. The other blue line is the Chinese high yield market. One of the key things that we don't like doing, we don't want people to do, is to try and chase yield for the sake of yield. It's really important. That market was cheap 6 months ago. It was cheap 3 months ago. It is still a risky market. It's not something that you do as a core component. You can look at it as a smaller component, but that's not something that we're looking at right at the moment. The key point here is there's a lot of influence out there in emerging markets. Emerging markets is changing a lot in emerging markets credit, and it's not something that we feel very comfortable with right at this stage. This slide here is trying to give you an idea on what is happening in the US credit markets. And the US credit markets are the bellwether of all credit markets globally. That is the most important thing. The distinction we want you to understand here is not everything within credit markets is the same. It's important to understand there's a difference between the yield premium and the duration component. They're very, very different with what they actually represent. The black line represents what we would actually call the most risky component of the US high yield market. However, it's actually outperformed the safer component over the last 12 months. And the primary reason for that is that the riskiest component has been a function of, is pretty much dictated by what's happening within oil, and clearly we know what's going on with oil at the moment, but the safer environment is actually represented by duration. So that's actually being influenced by interest rate expectations going forward. The fan charts on the right-hand side are obviously showing to you a little bit more about how we look at credit. The bottom chart is actually telling us and signaling to us that in the last 12 months, the domestic market is actually cheap at the moment on a relative basis. However, on a much longer basis, it's more in a fair value perspective. These are all the signals that we're actually be providing into the investment committee to actually decide how we're going to make allocations and to what at any one point. This chart is showing you how we think about inflation. There is more information, more media out there about inflation than anything you can think of. The chart on the left-hand side represents what's happening on a consensus view of what the economists are saying versus what the actual interest rate markets are actually telling you. One of the core components of this is that the markets are always thinking in advance of the economists. And as you can see, we had a bit of a switch over in late last year where the market didn't think so, but the recent events from a political perspective and what's happening with oil in particular, the market has started to really reprice inflation significantly higher. And this is in the US, very importantly. On the right-hand side, different story. What you're actually showing here is what's happening of inflation expectations long-term in the US versus what's happening long-term in Australia. Importantly, the US inflation expectations are significantly higher. It's relatively stable in Australia, and that's what markets are actually telling you at the moment. If we move on to here, this is how we think about the treasury market, the government bond market. The government bond market dictates how we set expectations for inflation, how we set expectations for the risk-free rate of return on nominal yields. I think the key element to this is when you're looking at it, the last 20 years, you've had an easy run with interest rates always rising. So bond markets have actually performed extremely well for 20 years. That's not necessarily the case going forward. You can get away with it with not looking at it. At the moment, it's far more difficult than it ever has been. And one of the key things we want to bring out in these conversations and start to communicate with you is you need to start thinking about these positions more and more frequently. This slide is designed to sort of give you an idea on what the alternative sources of yield. We are actively involved in the private credit market in Australia. I sit on AIMA's Alternative Credit Committee in Australia. We're actively involved. We have primers on the market and exactly how it works, how you can be involved, and what are the various terminologies that should be used. Ask your representative at Prime if you'd like a copy of that, so it's freely available. So one of the key pieces of information that we want to get through here in private credit, and that includes commercial real estate, that includes everything. Not all of these markets are the same. There is a lot of different markets within private credit. It's a very important distinction. So one of the things we want to just talk about here for a second is that we work with EY quite tightly on this market. The market, they just released a paper yesterday with us, and the market at the moment is about $133 billion. That represents about 11% of all corporate debt in Australia, and that's grown at about 22% year on year. It's a significant market. There's a lot of opportunities out there at the moment, but one of the things you should need to take into context is the chart on the right-hand side. That's actually telling you what the RBA is telling you across all funding. So that's an important function. As you can see, for small business credit, the cost of that's across banks and private credit, has been slowly going down, but we're at that position now where things are just starting to change. The left-hand side is trying to show you the different types of private credit opportunity you can get relative to what the banks would offer from a lending perspective to small business. This chart here is again trying to explain how private credit works within a portfolio at the moment. We've been big proponents of the market for some time. It's effectively like how we would build out a model portfolio and how it looks on a relative basis versus inflation. Inflation is the biggest killer of fixed income and credit markets. It's important to be in front of it. It's important to be on top of it. So the way we look at allocating to private credit on the left-hand side, and these all depend on your risk tolerance, obviously, but that's the relative benefits of the income and the yield you can generate on the private credit markets gets you to a point where inflation is mitigated, whereas on the right-hand side, without it at the moment, it's far more difficult to achieve that. Now, that is not going to be the case forever. That is going to be the case in the short for the moment, but things are changing very, very quickly, and that's part of what we were doing within the prime community is to get that information into the models and make sure that it's appropriately allocated. So I'm just conscious of time here, guys, but the key takeaways for us is that term deposit rates across the market will rise with interest rates, but they won't rise at the same pace. The income, all your floating rate investments will increase through time. They've already started. It's a very positive thing. So your income that you generate from them, our expectation is you get at least a 15% increase in that income in the next 12 months once this follows through. It's dependent on the stability of markets, clearly. And then the second piece, one of the other key pieces here, duration and treasuries, in a flight to quality, not everything is the same. So one bond is not the same as the other. You need to be really careful about talking about that. The final point here is with private credit, it's a big, big market. It's growing rapidly. It's not all the same. It's all different. If you've got any questions about it, please let us know. Thanks, Simon.
Perfect. Thank you.